This is the Net Group Investments Insights Podcast, where one or more of our experts explore a variety of views and insights that investors care about.
Welcome to another episode of Inside the Mind of a Fund Manager. I'm Mansoor Dunaka, Senior Investment Analyst at Net Group Investments. My guest once again is Andrew Headley, Portfolio Manager of the Net Group Investments Global Equity Fund at Veritas Asset Management. Welcome, Andy.
Thank you, Mansoor.
Most investors spend their time worrying about what's changing in the world. New technology, new business models, new risks, as we've seen recently with fears of AI disruption. But some of the most powerful investments are built on what isn't changing. People still commute, and goods still need to move, and planes still need to land. And every day, without thinking about it, millions of people pay to use infrastructure they can't easily avoid. Which brings us to today's focus, infrastructure, and specifically Vanchi. Vanchi is one of the largest holdings in the Global Equity Fund. Andy, for listeners who are maybe not that familiar with Vanchi and what they do, please give us a quick overview of who they are and how they operate.
Thanks, Mansoor. So Vanchi is actually a very typical investment for Veritas because, as I'll explain, it produces very, very steady growing earnings over time and is not really subject to competition. So what does Vanchi do? Vanchi primarily operates concessions for physical infrastructure. So think major toll roads and motorways, particularly in France. They're the world's largest airport operator. They own and operate renewable energy, particularly solar. Now that business, that concessions business, is actually only a small part of the company's revenue. It's only 16% of revenue, but it is 60% of profitability because these are exceptionally profitable things to run. And once you have the concession, obviously the reinvestment cost is relatively low. So concessions is the most important part of the business. They have two other parts of the business. One is energy, where the company is very well placed. In their energies business, they basically provide and build infrastructure, electrical infrastructure primarily, which is all around energy efficiency, data centers. Think of high voltage transmission lines. So this is an area where we're seeing huge growth in demand, particularly with AI. They will build data centers. They will build the network. So Vinci Energy is extremely well placed. They also have a business within that energy division called Cobra IS, which basically historically has been a renewable energies business. They do procurement and construction and operations of largely renewable businesses, so mainly photovoltaic. And that business, that energy business, is 40% of revenue, but it's only around a quarter of profitability because the concession business is so profitable. And then the last business, which a lot of people get hung up on with Vanchi, is their construction business. And that's a mixture of many things, but it's mainly major projects. So it might be road building, some office building, some infrastructure business, so rails, water, and some small residential business. Now, that business is 45% of revenue. So it's a very large part of revenue, which is why many investors get hung up on it. But it's only 14% of profitability. And it's actually relatively low risk because the average contract size is very small. And so whilst they may mess up on a few contracts, as is typical in construction, because the average contract size is small, the overall implications of that is that it can't derail the whole company. So Vanchi is primarily a concessions business.
Thanks, Andy. Sounds like a hidden gem, hidden in plain sight. Given the macro environment and given the recent events with inflation back firmly on everyone's radar, at least in the short to medium term, tell us why this business model is especially interesting in today's environment.
Yeah, so we really like these kind of businesses. Now, first off, why do we like it? Vanchi primarily owns and operates irreplaceable physical assets and infrastructure. Okay, now they don't own all of these things, but many they do own, or they have very, very long-term concessions. So out into some are in the 2030s, but most go out to the kind of 2050s, 2060s. So irreplaceable physical assets that they just can't be competed with. So they have limited or no competition. Nobody is going to build another airport where you already have an airport. Nobody is going to build another motorway where you already have a motorway. So we really like these assets because they have no competition. They are irreplaceable. Vanchi focus on those infrastructure assets that typically have very light regulation or no regulation. So particularly in their airports business, they focus on lightly regulated airports, which allows them to make a supernormal return. We also think the company is a really good capital allocator, so they've historically been able to redeploy their very prodigious cash flow into new assets, which allows them to grow a bit faster. And we think that their exposure to areas of growth are really interesting. So this is particularly in their energies business with data centers and electricity infrastructure, as well as their renewables business. And so we really think the company is extremely well placed for the medium and longer term. And as you touched on now with inflation, the company is fairly well protected against inflation because many of their infrastructure assets, they are allowed to price in line with inflation. So, for example, their toll roads, primarily in France, they typically are allowed to put through a price increase every year, which is somewhere around 2/3 to 3/4 of the inflation rate. And so if inflation goes up, obviously their pricing goes up. But realistically, these assets have relatively small maintenance capex requirements. And so the price increase largely feeds through straight to the bottom line. So we think they're fairly well inflation protected as well. So good in this macro environment.
I think as you described, the perfect business to deliver on that real return philosophy of Veritas Asset Management. I think something that you alluded to now previously, are there any other parts of OneStream that makes it a compelling investment opportunity? I think that energy side of the business, I think that feeds into, that AI theme. Is that another opportunity for you that you see that's growing?
It's a really good question, Mansour, because I followed this company for maybe 10 or 15 years. And I feel like the renewables business that they're developing is very underappreciated by other investors. And I'll try and explain why. At the moment, the renewables business is quite small. So they're investing between 600 million and €1 billion a year. Their total capital expenditure every year is about 4.5 billion. So of that, at the moment, around 1 billion a year is going into this renewables portfolio. And we're not really seeing the benefit of that in earnings because it takes a while. When you're doing a large photovoltaic project, it takes 2 to 3 years or maybe 4 years, including planning permissions, to bring that on stream. So they have 1.2 gigawatts of photovoltaic projects currently in operation where they're generating electricity. But they have another 4 gigawatts, which is under construction. Now, with their spending, which they've said will run forwards at around 1 billion a year, they should be able to deliver 1.6 gigawatts of additional solar energy with that 1 billion of capital expenditure. Now, if we roll forwards their current spending, and obviously there's a delay as these things, you have to do the work and then they come on stream 2 or 3 years later. And so you only get the earnings after you've sunk the capital in and you've done the construction. But once you have those earnings, it just relies on the sun. It has a very, very high margin once you've got the photovoltaic cells in place. And so if we roll forward to 2030, we think that they will have 6 gigawatts of photovoltaic assets in production and another 5 gigawatts under construction. Now, 6 gigawatts of photovoltaic in Spain and Brazil, which is where they are, should generate something like 1.4, 1.5 billion of revenues. And it will generate about 1 billion of EBIT. Okay, so at the moment, this is a business within Bouncy that is producing very small profitability because not much is actually producing energy. But by 2030, we see this as contributing around 1 billion of EBIT. Now, the company generates around 13 billion of EBIT in 2030. So again, it's not huge. It's growing from sort of 1 or 2% to maybe 8% of the company, but it's going to continue to grow because they're going to continue to invest in this area. So we see this as an area where we're going to see compounding up. This is really the compounding effect of long-term investment in these photovoltaic projects. And these projects will last for 20 to 30 years. So once you've sunk this capital in, the profitability that flows from them lasts for a very long time. So we're really excited by the company's renewable energy division, which they've just renamed Zero E. And we think it's highly underappreciated by the rest of the investment community.
Sounds like a fantastic runway, especially I think given, we're probably going to see a need for higher energy security, just given the recent events, right? So fantastic opportunity for the company and they're well placed, as you mentioned. To end off, so what's the big takeaway for investors listening?
Well, I think the big takeaway here is to understand that this is a very typical investment for Veritas. So it's irreplaceable physical infrastructure with limited or no competition. This is not something that is subject to threat from artificial intelligence or competition or any other major threat to the business. So we think it's a very stable, strong business with huge duration. You can look out 20, 30 years and Vanshi will still be there. People will still be flying around the world. Airports will still be operating. So we're very confident of the durability and strength of this business. And we think it will deliver very steady returns. So Vanshi currently delivers a dividend yield of 4%. Okay, so you have a base return of 4% just from dividend yield. We think the company grows at something like on a base rate around 8% a year. So if you just add those two numbers together and assuming no change to the company's rating, and it's only trading on around 14 times earnings and a 9% free cash flow yield. So if you assume that the rating doesn't change, doesn't improve, you should get a 12% return a year from this business. Now, we really like a business that can deliver us a steady 12% a year for a very, very long time. However, in a market that is rising very fast or is subject to a lot of greed around AI and hype around AI, people may not want to own an asset that just grows at 8% and delivers a 4% dividend yield. But we are very confident that over the long term, a 12% return like this as a base is extremely attractive. And we think there is upside from that 12% because we think the valuation could well increase, firstly. And we also think that the 8% growth rate could improve, particularly from their investment in renewables. So we think there's upside from 12% annualized return. And so we think this is a wonderful opportunity in a very, very stable business. And we just think it's very, very secure. So it's got duration, it's got quality. It's really, really difficult to compete with. So it's a very typical Veritas investment.
All the qualities you look for. Thank you for your insights and analysis today, Andy. Vanshi shows that some of the most powerful investments aren't about moving fast or disrupting industries. They're about owning things that people rely on every day and getting paid for it quietly year after year. In a noisy world, that kind of long-term compounding is especially valuable. To our listeners, thank you for tuning in. Until next time, stay informed and stay invested.
This podcast is for marketing purposes only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.